Picture this, not a made-up story, not a textbook example, a real American kitchen, a real Tuesday morning, a real phone call. Her name is Carol. She is 67 years old. She lives in a small house in Dayton, Ohio. Her husband, Thomas, a man who drove a delivery truck for 34 years, Thomas died 11 weeks ago. Heart attack. In the driveway. On a Sunday afternoon. The sympathy cards are still on the mantel. His coffee mug is still next to the sink. Carol has not moved it. This morning, her accountant called. Not to check in. Not to offer condolences. He called because what he has to tell her cannot go in a voicemail. He tells her, carefully, professionally, gently, that this year, the same year Thomas died, the same year she lost the man she married at 24, the federal government of the United States is going to take $31,000 more from her than it took last year. Same IRA, same pension, same bank accounts, less income than when Thomas was alive. $31,000, not because Carol cheated, not because she missed a deadline, not because she made a mistake, but because Thomas died first. And here is what should make every married person watching this video put down whatever they are doing right now. This trap is not a glitch. This trap is not bad luck. This trap was written into the tax code on purpose. And the IRS has known about it since 1983. 800,000 new widows every single year. And almost none of them, including Carol, were warned. I am going to spend the next 28 minutes showing you exactly how this trap works. The math, the mechanism, the timeline, and then I am going to show you the 4 legal moves you must make before the funeral. Because after the funeral, most of these moves are gone forever. We will unblur this list together, one move at a time, as we go through the video. Stay with me. What I am about to show you will save your surviving spouse somewhere between $40,000 and $120,000. Let us start with Carol's exact numbers. I am not going to give you vague examples. I am going to show you Carol's exact financial picture because it matches the profile of millions of working American couples who did everything right. When Thomas was alive, 2025, Thomas's Social Security, $1,850 per month, but $22,200 per year. Carol's Social Security, $1,100 per month, but $13,200 per year. Thomas's pension from 34 years of work, $14,400 per year. Required minimum distribution from their IRA, $8,100 per year. Interest from $52,000 in CDs at the local bank, $2,080 per year. Total household income, $59,980 per year. Now let us look at what the IRS does with that income when both spouses are alive and filing jointly. Standard deduction for married couple over 65 in 2026, $35,500. Senior bonus deduction from the new tax law, $6,000. Taxable income, $18,180. Federal tax bill, $1,848. Effective tax rate, 3.1%. That is the power of the married filing jointly brackets. Wide, protective, generous. Thomas dies. Carol is now a single filer. Watch what happens to the exact same income. Thomas's Social Security, gone. Carol's survivor benefit, she keeps the higher check, $22,200. Thomas's pension, 50% survivor benefit, $7,200, cut in half. Same IRA, same RMD, $8,100, unchanged. Same CD interest, $2,080, unchanged. Total income, $39,580. Carol's income dropped by $2,400. She is earning less than when Thomas was alive. So her tax bill should be lower, right? Here is what actually happens. There are not 1 but 3 separate tax mechanisms that fire the moment Thomas dies. Most CPAs only warn you about the first one. They miss the second. They almost never explain the third. And the third one quietly costs Carol money for the rest of her life. Blade number 1, the bracket collapse. As a single filer in 2026, Carol's standard deduction drops from $35,500 to $18,150. That is $17,350 less income she can shield from taxes. Overnight, because Thomas died. And the brackets themselves get cut in half. The 12% bracket for a married couple runs all the way to $96,950 of taxable income. The 12% bracket for a single filer ends at $48,475. Half the width, half the protection. Income that sat comfortably in the 12% bracket when Thomas was alive now gets pushed into the 22% bracket after he dies. Now watch blade number 2. Blade number 2, the Social Security ambush. When Thomas was alive, the threshold for taxing Social Security for a married couple was $32,000. Their combined provisional income was well under that. Most of their Social Security was shielded. Thomas dies. Carol is now a single filer. The threshold for taxing Social Security for a single filer is $25,000. The IRS shrank the protection zone by $7,000 the moment Thomas's death certificate was filed. Carol's provisional income now crosses that threshold. Result: 85% of her Social Security becomes fully taxable income. That adds $18,870 of income back onto her tax return, income she cannot spend, income she cannot avoid, income that exists only because the IRS changed the formula when she became a widow. Now the third blade. This is the one nobody talks about. Blade number 3, the IRMAA time bomb. IRMAA, Income-Related Monthly Adjustment Amount. This is the Medicare premium surcharge the government adds to your Part B and Part D costs when your income crosses certain thresholds. When Thomas was alive, the IRMAA threshold for a married couple was $218,000 of modified adjusted gross income. Carol and Thomas's income was $59,980, nowhere near that threshold. They paid the standard Medicare Part B premium, $180 per month. Thomas dies. Carol is now a single filer. The IRMAA threshold for a single filer starts at $109,000. Still fine for Carol. Her income is only $39,580. But here is the part that acts like a time bomb. IRMAA looks back 2 years. Your 2026 Medicare premium is based on your 2024 income. In 2024, Thomas was alive. They were filing jointly. Their combined income was $59,980, still under the single threshold of $109,000. Carol is safe for now. But what about the widow with a larger IRA? What about the couple with $400,000 in their retirement account? What about the surviving spouse whose accountant says, do a Roth conversion right now, and she does, and that conversion spikes her income to $130,000 in the year her husband died? Her Medicare Part B premium jumps from $185 per month to $259 per month. Her Part D surcharge adds another $13 per month. That is an extra $924 per year, not once, every year, for the rest of her life. And she will not even see the bill until 24 months later, long after she has forgotten what triggered it. That is not bad design. That is engineering. 3 blades, fired in sequence. The bracket collapse hits the year of death. The Social Security ambush hits that same year. The IRMAA time bomb hits 24 months later. There is no escape once the funeral is over. There is only escape before. Which brings me to the 4 moves. This is the biggest one. If you have money in a traditional IRA or a 401k, every single dollar in that account is a dollar the IRS has not taxed yet. They are being patient. They are letting it grow, because they collect later at a higher rate from a single filer who cannot fight back. Let me show you this with Carol's real numbers. Carol and Thomas had $210,000 in a traditional IRA. At age 73, their required minimum distribution using the IRS Uniform Lifetime Table was $8,100 per year. While Thomas was alive, that $8,100 RMD sat inside the wide married brackets. Tax on that withdrawal, roughly $810. Thomas dies. Same IRA, same balance, same $8,100 RMD, but Carol is now a single filer. The brackets are half as wide. The Social Security inclusion is higher, and that same $8,100 is now taxed at 22% instead of 10%. Tax on the same withdrawal, $1,782s, more than double the tax on the exact same withdrawal. Because Thomas died first, multiply that over 15 years of retirement, that is $14,580 in extra tax on just this one account. Now here is the fix. It is called a Roth conversion, and it must happen while both of you are alive and filing jointly. Here is the plain English version. You move money from your traditional IRA, pay the tax on it now, at the wide married rate, and it transfers permanently into a Roth IRA. Inside the Roth, growth is tax-free. Withdrawals are tax-free. No required minimum distributions, ever. When your spouse inherits it, still tax-free. And Roth withdrawals do not count toward IRMAA. Let us run Carol's numbers with this move applied. Carol and Thomas convert $25,000 per year from their traditional IRA to Roth for 5 years while Thomas is still alive. They pay roughly $2,500 in tax per year at the comfortable married rate. Total tax paid over 5 years, $2,500. After Thomas dies, Carol's inherited Roth has $125,000 in it. She pulls from the Roth first. Her taxable income drops significantly. Her Social Security stays partially shielded. Her IRMAA never triggers. Tax saved over the next 15 years, minimum $22,000. She paid less total tax and protected her retirement income. This is move number 1. One critical warning before we move forward. A Roth conversion that is too large in a single year spikes your current income. triggers IRMAA 2 years later, and costs more than it saves. You need a fee-only fiduciary, not a product salesman, to model the right conversion amount for your specific situation. I will tell you exactly how to find one at the end of this video. This move is counterintuitive, and getting it wrong costs surviving spouses tens of thousands of dollars in capital gains tax they never had to pay. Here is the right way to think about it. When someone dies and leaves investments to their spouse, the IRS does something almost no one expects. They reset the cost basis of those investments to whatever they are worth on the day of death. This is called the step-up in basis. Let me show you what this means in real dollars Carol can understand. Thomas bought $9,000 of a simple index fund back in 2010. By 2026, when he dies, that investment has grown to $43,000. Embedded gain, $34,000. Normally, if Carol sells those shares, she owes capital gains tax on that $34,000. At 15% long-term rate, that is $5,100. But because Thomas died and those shares were properly titled, Carol inherits them with a fresh cost basis of $43,000. She sells them the next morning. Capital gains tax, zero. The $34,000 gain, forgiven. Permanently, legally, gone. And this is where most couples make a devastating and permanent mistake. In most states, called non-community property states, if your brokerage account is held as standard joint tenancy, only 50% of the account gets the step-up. The other 50% keeps the original low-cost basis. Community property states, 100% step-up. California, Texas, Arizona, Nevada, Washington, Idaho, Louisiana, Wisconsin, New Mexico. Non-community property states, only 50% step-up. Ohio, Florida, New York, Georgia, Pennsylvania, and most others. The fix for non-community property states: set up a joint revocable trust with community property language, or in some states, a specific account titling designation. Cost: $500 to $2,500 in attorney fees. Potential savings: $10,000 to $40,000 in capital gains tax for the surviving spouse. This is move number 2. Title the account correctly. Before the funeral. This is the move that breaks my heart the most, because by the time most people understand it, it is already too late. Permanently. Here is how it works. When a working spouse retires and starts drawing their pension, they are given a choice. Most people make this choice quickly. Most people make it wrong. Option A, single life. Highest monthly payment while the retiree is alive. The day the retiree dies, payments stop. The surviving spouse receives zero. Option B, joint and survivor, smaller monthly payment, but continues paying to the surviving spouse at 50, 75, or 100% I for the rest of her life. Most couples choose option A, because option B means a smaller check today. And smaller checks feel painful today. And death feels far away. Thomas's pension was $1,200 per month with option A. Option B, joint and survivor at 50%, would have paid $950 per month. That $250 per month difference, $3,000 per year, felt like a lot to give up. Thomas signed option A. He collected that pension for 9 years before he died. Extra collected with option A, $27,000. Thomas dies. Carol's pension income, zero. If Thomas had chosen the 100% joint and survivor option, Carol would now be receiving $950 every single month for the rest of her life. Over 20 years, that is $228,000 of income Carol will never receive, because of a form Thomas signed without fully understanding what he was giving away. If you are pre-retirement, choose the highest survivor percentage you can afford. The monthly reduction is not a loss. It is the most important insurance payment you will ever make. If you are already retired on single life, you cannot reverse it. But you can use the pension maximization strategy. Take the higher single life payment. Use the difference in monthly income to fund a permanent life insurance policy on the retiree. When the retiree dies, the surviving spouse receives a tax-free death benefit under Internal Revenue Code Section 101A. She uses that lump sum to create her own income stream. No bracket collapse exposure. No IRMAA spike. No forced RMD. The pension becomes a tax-free survivor income stream. This is move number 3. This one looks completely harmless. A CD at the local bank. A treasury bond. A money market account. Safe, boring, reliable, and completely invisible until your spouse dies. Here is the problem. Interest income from CDs and treasury bonds is fully taxable as ordinary income. While both spouses are alive and filing jointly, that interest sits comfortably inside the wide married brackets. It barely registers. The day one spouse dies, that same interest gets pushed into the narrower single brackets and may push the survivor across an IRMAA threshold. Carol and Thomas had $52,000 in CDs paying 4%. Annual interest income, $2,080. While Thomas was alive, taxed at 10%. Tax on that interest, $2,800. Thomas dies, same CD, same interest, same $2,080. Now taxed at 22%. Tax, $458. Small number alone. But add it to the bracket collapse. Add it to the Social Security ambush. Add it to the IRMAA calculation. Every dollar of taxable interest is one more dollar pushing Carol deeper into the trap. Option 1. Municipal bonds. Replace CDs with high-quality municipal bonds from your home state. Interest from in-state municipal bonds is exempt from federal income tax under Section 103. In most states, also exempt from state income tax. Ohio resident, Ohio municipal bonds, double tax exemption. California resident, California munis, equivalent to a 6 to 7% taxable yield for a high-bracket retiree. Texas resident, no state income tax, focus on federal exemption, any AMT-free muni fund. Option 2. Multi-year guaranteed annuity. Think of this as a CD inside a tax shelter. The interest compounds inside the wrapper. It does not appear on your 1099 every year. No annual taxable income event. The surviving spouse withdraws strategically in low-income years at lower tax rates. Option 3. Cash value life insurance. For couples in good health, properly structured cash value insurance offers tax-deferred growth, tax-free withdrawals up to basis, and a tax-free death benefit. Carol converted her $52,000 CD into Ohio municipal bonds. Her interest income, still $2,080. Federal tax on that income, 0. Ohio state tax on that income, 0. Annual savings, $458, small alone. But combined with the other 3 moves, Carol's total annual tax bill dropped by $19,200. Over 20 years, that is $384,000 of generational wealth that stays in Carol's family, not the government's. Let me show you 2 versions of Carol. Carol did nothing. IRA, all RMDs taxed at single rate brokerage, wrong title, 50% step up only, capital gains tax paid, pension, single life, 0 survivor benefit CDs, fully taxable interest every year. Annual tax bill after Thomas dies, $31,000 over 20 years, $620,000 paid to IRS. Carol acted before Thomas. Died, Roth conversions completed. Inherited, Roth is tax-free. Brokerage retitled. 100% step-up. 0 capital gains tax pension on joint and survivor. $950 per month continues forever. CDs converted to Ohio munis. 0 federal tax on interest. Annual tax bill after Thomas dies. $4,800 over 20 years. $96,000 total tax paid. Difference, $524,000. Same income, same IRA, same pension, same bank accounts, same IRS, different architecture. $524,000 either stays inside Carol's family or gets handed to the federal government. That decision was made years before Thomas died. Listen carefully now. Roth conversions require 5 to 7 years of carefully staged moves to avoid spiking your own bracket and triggering current year IRMAA. Pension elections are locked permanently the moment you start drawing. There is no form to reverse it. There is no phone call that fixes it. Life insurance underwriting requires both spouses to be in reasonably good health. One serious diagnosis, and the underwriter closes the door. Trust restructuring and account retitling requires both spouses to have legal capacity to sign documents. If cognitive decline has started, that window may already be closed. The IRS is patient. The IRS knows most couples will say, "We will get to this later." The IRS knows that grief is disorienting. The IRS knows that a widow sitting alone at a kitchen table reading a letter she does not understand is much easier to collect from than a prepared couple who sat down together on a Tuesday evening and ran the numbers. 3 things before you close this video. 1. Save this video right now. Hit the bookmark icon. Hit the save button. When the letter from the accountant arrives, when the CPA calls, you will not remember these details. This video is your reference manual. Save it tonight. 2. Drop a comment below with 2 things. What state you are in, and roughly how much is sitting in your traditional IRA or 401k right now. I read every single comment. Your situation helps me build the next video, and it helps every other couple watching this channel who is sitting in the same position. 3. Think of one married couple you care about. One couple, not your whole contacts list. One couple, where one of them is already retired, where neither of them has ever heard the words widow's tax trap, or IRMAA, or step up in basis. Send them this video tonight. The 4 moves are not complicated. The strategies are not illegal. The escape hatches are written inside the same tax code that contains the trap. You just have to use them before the funeral. I will see you in the next video.